Let's next, though, think about some of the longer-term implications in our Wrap the Week segment. So, the idea with Wrapping the Week is to think about the big picture, think about where we're seeing, longer-term trends and really trying to connect the short-term movements to the long-term. So one of the polls that we asked you recently on StockCharts TV, and as you know, on the side of the screen, you'll see a little poll that we have up, and we really have it up all the time that there's programming. So anytime you see something on there, make a point of answering, because we collect all of those and we'll review them on air, some of the better ones. So we asked you actually recently what you were planning to do with your current investments in the stock market over the next 2 months. So really leading into January, beginning of January. Continue to buy stocks, hold stocks I own and not buy anymore, or sell stocks and take the money, take the cash away. 66% of you, 2/3 of you, said you were going to be continuing to buy stocks over this period. And then the rest were split between holding stocks and not buying, and then selling stocks and kind of cashing out a little bit. I think that is how the market feels here, right? I mean, if that's true, and if 2/3 of us paying attention, 2/3 of investors are continuing to buy, that's what's going to make these charts continue to go up and to the right, especially during this period of seasonal strength. But I thought that was a really interesting takeaway from all of you. Not many people wanting to take any cash out of the market, and again, hopefully, from our show where we continue to talk about momentum and trend following and staying with strength, you've been listening, which I appreciate. Thumbs up to Final Bar Nation here, paying attention. But overall, I thought it was an interesting takeaway. So most of us, if not 2/3 of us, thinking this is a time to continue to buy. Let's think about some other ways we can kind of wrap up the week here. Looking at some of the long-term charts, I always want to go back to the weekly chart. For me, the weekly chart is the first thing I look at every morning during my weekly chart review. I always start with the weekly chart. And I have a couple different ones that I kind of rotate around. But I think it's really important to start your day, start your weekly routine thinking about the long-term picture. That's if you're a long-term investor. So if your horizon for an investment is 3, 6, 12 months or further down the road, you really want to be starting with the weekly chart, a longer term time frame, so you prime yourself, you orient yourself to the big trends. And there is no denying by any measure, if I showed my 3-year-old son, is this going up or down, he might actually struggle, Henry, a little bit, but that's okay. But the average person would recognize clearly in an uptrend, right? You have higher highs, higher lows. You're above 2 upward sloping moving averages. This is the 40-week and 150-week that we're using here, so pretty long term. And you can see overall, it's just in a strong position. This last 2 years looks like a really interesting basing pattern. We have the resistance level that we've now eclipsed, and we're certainly in a position of strength. So, it's worth noting that all the volatility, all the movement that we've been talking about since we started the show a couple months ago has been in this far right side where it's just been long and strong, continuing higher and up to the right. So overall, the trend, I would argue, has been pretty significantly strong. We're going to go to the Mindful Investor Live chart list and look at some of the themes here. This is the S&P breadth by capped here. So this is the closing prices of the S&P 500. We're then looking at breadth in the form of the advanced decline line, cumulative advanced decline line. This is the S&P 500 in the top panel. We then have the broader New York Stock Exchange, mid caps, small caps. And what jumped out at me looking at this chart yesterday, actually on the plane back from New York, was looking about how the S&P continuing to new highs, but look at how the broader NYSE actually sloping downwards. Mid caps holding in okay, but small caps sloping downwards as well. So, this is really an illustration of breadth. These are all, advanced decline lines are by definition an equal weighted measure. It just looks at the number of stocks up or down every day and tallies that total over many days, many weeks, many months. The fact that the small cap line, the NYSE lines are turning down means that there is a smaller and smaller basket of stocks that are really pushing the market higher, and it's in the large and mega cap space. Now, again, that critique has been made many times over the last year. And overall, as you see from today, the market has ended at a higher point. So it is not telling you this is the end, but it is one of those red flags that I want to pay attention to. And if I would start to see the small cap breadth breaking down, I may want to think a little bit more about overall participation and see if there are any issues. I was on Real Vision earlier this week, did an interview talking about sort of a top-down process looking at the charts, and this is one of the charts we spent some time at, looking at the percent of S&P stocks above their 50-day moving averages. What concerns me from a big picture perspective is as the market has gone higher, this is a weekly chart for the last 5 years, as we've pushed higher and higher, less and less S&P stocks have actually gone above their 50-day moving average. Now that's interesting here because the S&P itself has actually gone above and below its 50-day moving average. So on each push higher, It's been above the 50-day, then it corrects and goes back below. Then it returns to a position of strength, makes new highs, goes back above the 50-day, and then comes back below. So the index itself has fluctuated above and below that barometer. Now this bottom panel, I think, makes a little more sense, a little more relevant, because as the S&P has done that, this is essentially telling you that less and less individual stocks have been doing the same thing. So as the S&P has pushed to higher highs, pushed back above the 50-day, less and less S&P stocks have done that same thing. That is not a sign of internal strength. That's a sign of really internal concern that it's narrower and narrower leadership. Obviously, the market has still had plenty of momentum. It's gone higher, as I think I've pounded to the table enough today. But overall, again, some signs of weakness when you look at more of an equal-weighted, more of a breadth-oriented approach. This is that ratio I talked about in the earlier, talking about today's trading, where consumer discretionary and staples both at the bottom of the list. That's one of the reasons why this ratio has really been sideways as the market has gone to new highs. Why isn't this ratio at new highs as well? Because this is telling you investors within consumer are essentially rotating away from the more conservative staples into the more offensive consumer discretionary, and we've not seen that. It's actually remained muted, and I think there are a lot of reasons for that. Number one is Amazon. Amazon has not been one of the best charts. That's a huge weight in the consumer discretionary sector. So if Amazon struggles, that structure, that overall sector, including the XLY, is going to be hard-pressed to go to new highs with such a lag on performance. And I would say that's probably one of the main reasons. The equal-weighted number is not much better, though. It's in a little better place, but not dramatically better. And I think that's one area of concern. One area of absolutely not concern is the relative strength of semiconductors. We've looked at this chart a number of times, the ratio of the SMH versus the spiders, so semiconductors relative to the S&P. This is a great market tell because it tends to do well in bull phases. It tends to struggle in bear phases, and there is no denying that this has been in a strong uptrend. It was questionable back here in October. The market's choppy. It breaks out, but then fails on the breakout, comes back down. But overall, it's followed through to the upside. And I mentioned earlier how many semiconductor stocks are at the top of the list of all large cap U.S. names. So really in a position of strength. That is telling you to remain foot on the gas pedal, driving hard in the coming weeks and months until you see some sort of rotation there, some sort of change. I want to go now to the scooter reports. So if we go here to our member tools on your dashboard page, go down to the scooter reports. We have a 1 week report, which I will rotate to. Usually it defaults to like an intraday report, which is great, but I like looking at it on a 1 week basis to see what's changed. I'm going to change to the industry page. So these are the top rated industries out of about 100 Dow industries. Number one, computer hardware. This has Apple and others. Furnishings, which we talked about, Mohawk is in this group. And then semiconductors, number 3. So that's a pretty strong trifecta of strong industries at the very top of the scooter rankings. At the bottom, we have things like coal, and I would always remind you the chart of coal, the chart of brewers. These are ones to remind yourself, never confuse the bottom of the page with support, right? When something goes down and it goes down a lot, that is not necessarily a reason to buy it. You better have some sort of idea as to why that's going to rotate, because things that have been down, they're usually down for a reason. Price just doesn't go down on its own. It goes down because of distributive pressures, and that's certainly the follow-through that we've seen. But what I want to focus on are the changes. So these are the industries that have rotated the most during this week. So home construction actually up the most during the week. This is things, like home builder names essentially in that group. Broadcasting and entertainment, so something like Disney with the new Disney Plus, which my family, anecdotal evidence, my family forced me to purchase yesterday and subscribe to. That's doing very, very well. It's obviously driving that group very, very nicely. Then you have something like conventional electricity, which I would not logically think of as a strong group. So it's a great reason to look at these scooter movers, because you'll find things that have moved that might not necessarily be on your immediate radar. Things moving down, it's non-ferrous metals, it's in the materials sector. We saw materials at the bottom of the list on today's trading. Auto parts is another one, has been a really good group with some really interesting charts, compelling charts, AutoZone and others, but now rolling over a little bit. So that's a group worth paying attention to see if we get some distribution. Then the last thing I would do is look at large cap stocks and actually see where we've seen the movement. So advanced auto parts coming off has been one of the biggest pressures. That's why that group has been down so much. You saw Mohawk as well has been one that has been in that strong group. Furnishings really pulled back, so that group might actually be struggling a little bit. In terms of stocks on the move, I mentioned Disney. That's certainly been one of the big ones, but also random names. Again, something like Tyson Foods, I would not normally think of as the juice, as something leading the way higher, but sort of in a, if I had a lot of charts that look kind of like this, I'd probably feel fairly decent about things. A nice pullback, a nice rotation, testing new highs. You want to see if that gets through the 93 handle, 94 handle, and continues on further.